And we are back. The first day of the month of October. We're officially about to end the year, the final quarter of the year. Inflation numbers have come out for the month of September. We're touching our all-year low, 3.83%. Second quarter GDP numbers are also out. That's about 5.6% quarter-on-quarter growth compared to 6.4% same time last year. So not very interesting numbers that are coming out, at least on GDP. For us, we are discussing the sub-Saharan markets. What are investors looking at? What is foreign sentiment looking like? And really, are there any other asset classes that are offering better returns and better opportunities given what's happening in Kenya? Mr. Charles Miano is an equity analyst with Nabo Capital. He will be joining us today to expound on this opportunity across the continent. Welcome to the show, Charles.
Yeah, thank you very much.
All right, before we touch the sub-Saharan Africa investment case, have you seen the numbers on GDP and inflation, and what are your thoughts?
Yeah, I had a look at them this morning. I think if you're touching on inflation numbers, the lowest that we've seen since April, coming off around 5% in August, recording of about 3.83% that you mentioned earlier on. I think what we've seen is better results in regard to agriculture in terms of food inflation decline, and also if you touch on fuel inflation, what we did see was sort of like a base effect. So there was a pickup in oil prices, especially towards if you look at July and August, and therefore given that high base, what we've seen through September is sort of like a low number in regard to the month-on-month gain.
Okay.
So that also led to that. So expectation on inflation, we see perhaps it being below 5.5% as we go to quarter 4 2019.
Okay.
So those are good numbers to see. And also if you look at it from an investor's perspective, looking at a 1-year treasury bill around 9.7%,
yes,
3.8% inflation gives you about 5.8% on real yield. So
okay,
does look
so that's
promising.
A good one. Okay, but before we went to the show earlier, I think I was just picking your brain on this, and you're saying yes, it's a good number on paper, but then we asked the question: if you have 1,000 shillings, and this really came from you, if you have 1,000 shillings out there, are you feeling that you're actually getting more value with your 1,000 now than you are in April? Is that a different way of looking at it?
Yeah, that's actually the way like a common man should look at it. How much can I? If I have my 100 shillings, 1,000 shillings, how much of the basket can I get?
Okay.
Am I getting more value in that 1,000 shilling relative to what I got, let's say, a month ago or 3 months ago? So I think it'll take time over a long period of time. I don't think it's like a flip of a switch where things are cheaper. But now the question is, prices, will they stabilize? Because the question now is, prices are actually going up. So inflation means prices are going up, but depends now on the rate at which they go.
On the rate of change, on a month-on-month basis.
Yeah, so the expectation is you won't have your basket fuller this time around relative to maybe 2 months ago.
Yes.
However, you'll keep it almost at the same rate it was,
yes,
relative to how it grew maybe in the last 3 months. So that's the expectation that especially consumers should be looking at. And also as investors, where we're asking ourselves or comparing in terms of relative real return, are we getting the best return out of our investments in fixed income? Okay,
interesting. And just maybe before we go to GDP, is that the risk of having lower returns with regards to the fixed income and the yield curve? Do you have any expectations of a lower yield in the fourth quarter if you're also expecting inflation to come off? Or what are your thoughts when you're looking at the yield curve?
I think the expectation, the yield curve is bounded by one, what we see as a result of the Banking Amendment Act in regard to Finance Act, whether we'll see the interest rate cap come off or not.
Yes.
I know given the current proceedings, it's likely to remain as is.
Okay.
So with that expectation, especially on the short, longer end of the curve, is for it to actually come off.
Yes.
We've seen on the short end it improve. We've seen, for example, the 364-day T-bill move from 8.9 to about 9.7%. So expectation is for the short end of the curve to remain at least relatively stable.
So about 1 year, 9.7%, give or take?
Give or take, while the longer end, where you're talking about perhaps 10 years and above, you could see some decline.
All right. Okay, so it's interesting. So in as much as inflation is coming off and the expectation is at least will remain within the Central Bank of Kenya target range at 7.5% to about 2.5%,
Yeah.
there's still the risk factor of lower yields, especially on the in the medium to the longer end of the curve. Okay, fine. Now let's look at GDP growth. That's 5.6%. Was that a number you're expecting? Do you have an outlook with regards to the full year 2019 with regards to GDP growth?
I think on the outlook for the year, guided by IMF, is about 5.8%. And the central bank governor did mention that the expectation is about 6%.
6%. Okay.
We've seen the numbers sort of decline from about 5.8% this time around to 6.4% and quarter to 2018.
Yes.
So there is some pressures, especially when you look at agriculture, which constitutes...
So agriculture it's just, okay.
Yeah.
All right.
And also you've seen sort of like a decline a bit in the manufacturing. I think it grew by about 4.7% last year, grew about 4.3% this year. ICT sector is doing relatively well, and we did see the fact that central bank governor did mention that tourism is picking up.
Yes, it is.
So expectation for us is perhaps around 5.8%, just
Okay.
for in line with that.
With what the IMF is saying.
With what the
Okay.
IMF is saying.
All right,
Yeah.
interesting. So we have an overview of what's happening with regards to the expectation on different asset classes as well as expectations on key macroeconomic variables. That's GDP as well as inflation. When you're looking at sub-Saharan African markets, how do they look like if you compare them to Kenya today, just on an overall very broad basis?
I think Kenya is relatively is growing relatively well.
All right.
We are seeing some decent numbers all across, nevertheless, in Uganda and Tanzania as well. But if you're looking at it from a sub-Saharan perspective, for example, if you're touching on Nigeria, expectation for Nigeria for FY19 is about 1.9%.
1.9%.
Yeah.
So again, what we keep hearing is we are not very well, you're not doing very well, but again, we're the best of a bad batch. Is that something that holds?
Yeah, it depends on the key drivers of growth as
Okay.
well, and how fast, or the expectations around that, and what's actually driving that growth, right? And on the back of that, how much debt is being accumulated to drive growth.
Okay.
Because you can have an infrastructure, public management sort of debt drive relative to what you might prefer, whereas there's more of like private sector credit growth, which we are in some other forms lacking in Kenya due to the caps. So again, it's where also it's dependent on where the country is coming from. For example, if you touch on Nigeria, coming off a recessionary year in 2016, they've been growing quite modestly.
Okay.
Last year about 0.6, 0.7%. So expectation for this year is about, as I mentioned, 1.9%. So the key drivers for them now, it's more or less stability in the oil prices and the oil output increasing.
Okay.
So again, it depends, are you able to diversify your growth across different sectors? And maybe the key thing for Kenya is the fact that they're able to diversify their growth across multifaceted of sectors, which is relatively good relative to
so having a diversified economy actually makes positions us in a better perspective if you're looking at the investment case across sub-Saharan Africa.
Yes.
The diversity in Kenya is certainly better than just being reliant on one particular export commodity, is it?
Yeah.
Okay, fine. And when you're looking at the returns, let's look at equities. So what equities are doing better? I mean, the month has just ended, the quarter has just ended. Do you have a sense of what markets have done better compared to Kenya, or what markets have done worse compared to Kenya?
Yeah, for us, we usually track the performance of about 16 markets.
Yes.
And we track them against the performance of the equity indexes against the dollar. So in other words, we're quoting it against the dollar, seeing where it moves. And what we've seen out of the 16 markets, only 4 markets are positively performing over the whole year.
Wow, only 4. Okay, so which 4 are these?
So the best performing is Zimbabwe at 58.7%. You have Egypt at 16.7%. You have Uganda about 3.8%, and you have Rwanda at 0.8%.
Oh wow, Kenya is nowhere there.
Yeah, Kenya as at Friday, this was on the 27th of September, Kenya against the NSE 20 index was about 15 to 16% down.
Okay, that's not very good.
Yeah.
So then the question is, final quarter doesn't have the highest trades unless you have block trades that are going through. And we have been seeing the conversation that we are hearing out there is, okay, fine, the market is on a 10-year low with regards to the NSE 20 index. There are opportunities to actually maybe accumulate some good dividend yielding stocks for the longer term. So are you bearish, are you bullish when it comes to Kenyan equities? And how does this compare to countries say like Nigeria, Uganda, and Rwanda, which you've also mentioned a bit earlier?
I think now in terms of our perspective, we're looking at valuations and how, if you look at the PE ratio, for example, relative to...
So that's your price to earnings ratio.
Yes.
That's a good barometer for now.
Yeah, that's a good parameter to seeing how cheap stocks are relative to comparing that to maybe other periods in the past or comparing to other markets. And we've noticed like for most markets, they are almost within the African space or sub-Saharan space. If you touch on that, they're down, around 3 to 5 year lows. So stocks in this case seem relatively cheaper relative to where they were historically. But again, something to mention is the fact that we've seen constraints in some of the stocks, especially if you touch on Kenya. We have seen pressures, negative pressures in terms of performance, right? For example, last week we saw Mumias going to a statutory management under 12.5 billion debt crunch. And we've seen, and look at some stats, about maybe 15 companies are caught up in some either financial wrangles of some sort or corporate governance situations within the listed space in Kenya. And we're also seeing some recoveries, let's say, for example, in companies or stocks, especially the banking sector in Ghana, where it's coming off a situation where NPLs were upwards of 22%. So the
non-performing loans, and there have been a lot of structural changes in that economy as well. Okay.
Yeah. So there is sort of a shift where maybe 5 years before there was that thriving of the market, and especially if you look at 5 years, it was around 2014 where we had a peak in the oil prices, peak in the commodity prices, and this commodity, you touch on cocoa, you touch on copper. So there were a lot of fundamentals leading to why the valuations were that high. But now things systematically have changed. Or structurally have changed. So we also have to weigh that option, despite maybe stocks looking cheap. You have to weigh that.
So in a way, every economy it's a different bag, and you have to look at it very differently. Okay, we'll come back and talk about the foreign participation and the sentiments across sub-Saharan Africa. But we take a short break. The NSE has closed. Look out for the closing bell.